Angel is brought to you by NetSuite from Oracle, the only system you need to run your business. Go to netsuite.com/angel to get your free guide called Crushing the 5 Barriers to Growth.
Hey, everybody. Welcome to Season 2 of Angel the Podcast. You can go to angelpodcast.com. This is the podcast that we started in order to discuss early stage investing for startups in the high technology space. When we say angel investing, if you're new to the game, we're not talking about angel investing in a pizzeria or your friend's album or movie. We're talking about professional early stage investment in high growth professional technology companies here in the Bay Area and beyond. So every episode, we like to have a guest who does early stage investing. Early stage investing can have two different names. You can call it angel investing, or you can call it early stage venture capital. There is a simple definition to define these two things. An angel typically, but not always, invests their own money, and they act as an independent one-person, one-man band, if you will, one-person band. Venture capitalists in the early stage typically are a team. They typically have a fund. That fund of money is coming from contributions from limited partners, rich people, endowments, family funds, etc., who are putting that money in the hands of a partner to then invest and distribute those funds. So on this program, it's called Angel, but we also have early stage VCs because essentially we're all investing in the first couple of rounds of financing of a startup. Now that we've laid that groundwork, you yourself should go by angelthebook.com and read the book. This is the podcast companion to the book I wrote in 2017 called Angel. You can go buy that book, angelthebook.com, or go to Audible, Amazon, Barnes & Noble, or your local bookseller and buy the book. Or if you want to listen to it, I actually read it on Audible. Okay, we've got that housekeeping out of the way. And today I'm very excited to have a very old friend of mine on the program. And I don't mean that Ed's very old, although we're getting old.
Yeah, we were once young, dumb, and ignorant.
We met in the 90s in New York when I was a journalist, and he was an investor. He is still an investor and has done very well, and he invests in enterprise companies primarily. Ed Sim is on the program today. You can follow him on the Twitter, Ed Sim, EDSIM, and you can follow him on AngelList, angel.co/Ed Sim, and his company is BoldStart Ventures. Welcome to the program, Ed Sim.
Thanks, Jason. It's a pleasure.
It's good to see you.
It's been quite a while, man. Quite a journey we've been on together for sure.
Exactly. We met 20 years ago, I guess.
Yeah.
Or so.
We had some epic times.
Fun times back in the day.
There was no technology, no nothing back in New York, and here we are on the West Coast catching up.
Yeah, exactly. And now you, how did you get into early stage investing? I never asked you this. I'm curious.
Yeah, it's funny. When I was at school, a friend of mine's brother on the lacrosse team was a venture capitalist and came in and spoke about VC one day. And he said, it's kind of like...
What school is this?
This was Harvard undergrad.
Harvard.
Yep.
Look at that. This is the thing about the Harvard folks. They never want to tell you because when you say Harvard, everybody goes, F you. You went to Harvard.
Yeah.
God damn it. Everybody's got an issue with Harvard.
I just like to say school, and this is from a poor guy who's part, North Korean, part South Korean, right? So I feel very fortunate to have gone there, but I don't want to kind of,
And in fact, your father fled North Korea. Is this correct?
He did. He walked 100 miles.
How old was he?
14, 15.
Your 14, 15-year-old father walked how long?
About 100 miles down into when the U.S. pushed up into North Korea. He walked on the side of the road with many others. By the way, he wasn't the only one, with his mother and sister. And it's
what a story.
Yeah, and then he met my wife. He got picked up out of the streets, fought in the war, and then met
your mom.
Met my mom, excuse
his
me.
Wife,
yeah, his wife, my mom, in college.
Wow.
And they picked up a bag and moved to Baltimore, Maryland, with just a trunk and my brother.
Which must have seemed like an easy journey when compared with leaving North Korea during the war, but still an amazingly bold thing to do.
It is. I feel like that has defined a lot of just who I am as a person. I always feel like there's just a chip on my shoulder that I can always be better, and and that's what I look for in founders too.
Father fled North Korea, son goes to Harvard. That's a pretty good story, Ed.
Hey, man,
What did your father think when you got accepted to Harvard, I wonder? This must have been mind-blowing to him, having been a 14-year-old who fled North Korea, barely getting out with his life, to see his son
it was
go to the greatest educational institution in the world.
it was unbelievable for him and for me.
Did he cry? What was that moment when
He
you
did.
told him?
He cried. My mom just was in tears, and it was quite an
Did you
experience.
get a letter? How does it work when you get into Harvard back then in the 80s?
You get a thick package, right? The rejection letters were very kind of small, and then you get a big packet with like a book, like a welcome book, right? And that was the big thing.
Who got the package in the mail? Were you sitting there waiting? Was your mom like waiting for the mail every day?
I knew the exact date. December 15th, I believe, was the date. So we all waited at the mailbox outside of our row house. And
literally waited outside for the mailman to come.
Yep.
The mail carrier comes.
And we see a thick package with the logo on the front.
Oh my God.
And I
I'm
was
getting
like,
chills.
Yeah, I was like, unbelievable, man.
So you see the thick packet, and you know from having talked to other people that this is probably good.
Yep.
And what happens? You just all start crying before you open it, or you rip it open outside the house?
We pretty much ripped it open outside the house and just kind of verified and reread it like 3 times and just said, yeah, it's true. Now I need to figure out how we're going to pay for it.
Wow. Yeah, because it was at the time $20,000 a year, 15, 20,
$25,000 a year, I think. Yeah. So basically, like we took out a lot of loans. I got some grants.
Amazing.
And I had a job at school.
Incredible. Were there? And this is an interesting. I'm interested in the answer to this. Did you ever meet somebody from North Korea who was going to school at Harvard? In other words, the equivalent of your father having escaped from North Korea going to Harvard.
No.
That's not happened.
No, I don't think so.
Because so few people have gotten out of North Korea.
Absolutely. It's a.
And did they know this when you were applying and everything, that you were of North Korean descent? This was like part of the dialogue?
I wrote a story about just kind of like what drives me as a person, just kind of all the stuff that they'd went through and how fortunate and lucky I am and how lucky we all are to be here in a time of peace and prosperity for everyone. So I kind of pinch myself sometimes when I look at my dad, and like he started out in the mailroom at this medical publishing company called Waverly Press, and he worked his way up into the IT department and kind of eventually managed the IT department. Yep.
He went from sorting mail, then probably fixing computers, or installing laser printers like I did.
Buying a lot of computer associates. I remember him coming back with CA logos, mainframe stuff, old school. I remember he'd come back from every conference and have, Dad, where's my T-shirt?
Right.
Where's my
Here's your Novell T-shirt.
Where's my tchotchke? So if you're out running
here's your squeeze ball from Banyan Vines.
Never forget to get a squeeze ball for your children when you're at conferences.
Absolutely. No, these little trinkets mean a lot.
Oh yeah, little pens, those cheap 10-cent pens. They love it.
And he worked his way all the way up.
Yep.
To be running the IT department. Amazing.
Yeah, and he was a philosophy major, right? So he's a really smart guy. But he had to do what he had to do.
And at the time when you went to Harvard, was the backlash against Asian students happening because of the overperformance in standardized testing we see today? We're sitting here in 2017, in December of 2017, for people watching this years from now. And Harvard's going through a heck of a reverse racism or reverse bias kind of issue where they were a minority group, Asians, were being kept out of Harvard in some systematic way, according to some of the information we're starting to get. Did you feel that tension there when you went? And what are your thoughts on that?
I felt zero. At the time.
Oh, that's great.
And I grew up in Baltimore, so I went to an all-boys high school, Jesuit high school. And, there are probably 3 or 4 Asians in my whole school and probably 10 minority in the whole school. So it was quite fascinating for me when I visited school to see kind of the melting pot of the United States all in one place.
So you're in Harvard. Your friend's brother from the lacrosse team comes to Harvard and gives a talk.
Yeah.
Where? In a business class or?
Just kind of career networking. The team sat down and talked about and heard about different careers. And, we heard about Wall Street. We heard about consulting.
This is in the 90s, late 80s?
Early 90s. Early 90s.
92, 93.
Yeah, he talked about venture capital. And he said the coolest thing was working with someone with an idea, and you don't know if it's going to work. But then one day it shows up on the cover of the Wall Street Journal and you're transforming people's lives somehow. And you have a combination of product building, of of dreaming, but also, a combination of finance too. So it's just kind of a fun job all the way around.
So how do you get from being inspired to join the venture capital revolution occurring in the 90s to actually getting a job? I mean, obviously going to Harvard's a pretty good start.
Yeah, that's a great question. So I basically had no idea what venture capital was or private equity or anything else. There's no information out there.
No, there's no web.
Yeah, and so basically I went to the Office of Career Services and I looked through binders. And then I tried to get the address of every single private equity firm, every single venture capital firm, and I sent a cold letter out.
Cold letter?
To 100 different firms. I remember I counted them all across the country and said, hey, I would really like to get into venture capital. This is what I do. This is why. And only got one response back, one letter back.
Whoa.
And basically the letter said, hey kid, just get some work experience first. Like you have no idea. And I had no idea either. So
right.
I was like, all right. I ended up getting a job at a firm called Equitable Real Estate for a year doing real estate investing. I was the only analyst working on some big real estate deals. I kind of got bored. And then ended up, a buddy of mine said, hey, come to JP Morgan to the structured derivatives group and help us build quantitative trading models. You're pretty good at math. Let's figure this out. So I went over there. And it was, I got to tell you, it was insane. We managed $11 billion at the time running through Excel spreadsheets. So every day I walked in the office. The first 4 hours were I was basically a data junkie. I just sat there and entered data in.
Data entry.
Data entry, dude. And I got paid a lot, but I just entered data. I was like, this is freaking horrible.
Yeah.
No one should do this. And so
where's the API?
I was like, there's got to be a better way. This was 1994. So I was like, all right, I got to find out how to automate this. So I bought a book in Visual Basic. And my buddy and I, he's from Duke, we sat down and we're like, all right, we're going to actually spend the weekends and we're going to just hit a button and just going to ask us 3 questions, like what was the closing price here, blah, 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 and it'd do the work for us. And it'd go through, all 50 accounts. So we did that. It took us about 3 months. I learned how to code a little bit. And one day, about 3 months after that, the portfolio managers came to us and said, you guys are taking 3-hour lunches, but you're getting your work done. And then you're asking us for more to do. What the hell did you do?
Yeah.
I said, well, see this thick book here? It's called Visual Basic. I learned how to code a little bit, and I automated my job. They said, you know what? We're working on a project, and this project is going to turn our historical-based trading model into a real-time trading model. Can you work with the C++ developers? We're going to take live Reuters feeds, feed it into our system, and we're going to turn it into a real-time trading model instead of using yesterday's prices. I was like, yep, I'll help you do that. So we did that for about a year. So we really automated our jobs away, and I was like, maybe I should do this, try to get in this venture capital thing. And at the time, I downloaded Mosaic browser. And I was like,
mind-blowing experience.
Just like 94, 95, I was like typing stuff in. I'm like, oh my God, this is revolutionary. I was grabbing data from JP Morgan downtown, like risk correlation data, boring shit. Yeah. Pulled it in, and I was like, I can't believe I can just do that. I mean, you know, they don't have to send me an inter-office file.
Right.
It takes 2 days.
Yeah. Floppies in the mail. I
was like, I got to do this. So I literally was looking in the Wall Street Journal and saw an ad for looking for a venture capital associate in New York.
Wow. So there was an ad in the journal back when they had classifieds.
Yes.
And you saw it in the classified ads. School, it's a date. Exactly how old we are now.
Oh, shit. I shouldn't say that. Oh, sorry.
It's okay. It's too late. We'll beep it out. But literally, a classified ad said they were looking for an associate, so you went to work for a VC firm.
Yep.
Which one was that?
It was called Prospect Street Ventures.
I remember Prospect Street, sure.
And I was there for about 2 years, and the goal was to turn New York City into a high-tech, they called it a high-tech hotbed, clustered. And it was funded by the New York City Economic Development Corporation and a bunch of other corporates, and that was it. That was the beginning. That's kind of when we met.
That is when we met, when I was a journalist there. And now you are... have your own fund. You've raised your own funds. You've done this a couple of times. Tell us a little bit about BoldStart Ventures. What do you look for in terms of deals, and where do you get your deal flow from?
Sure. So I'll be very succinct. There's a lot of kind of debate in our industry about pre-seed, seed, and post-seed. I mean, it's
pre-seed, seed, and post-seed.
Yeah, I mean, it's so confusing. So what we do is everyone go to firstcheck.vc right now, and it's going to show up to our website. So we're a first check investor for technical enterprise founders.
Got it.
That's it.
And first check means you literally be the first institutional money to go in. So you will invest pre the product being launched in some cases, or shortly thereafter when the product's been launched and in market.
Yep, but mostly I even love being the first check-in. I mean, the company that you and I are both in,
Superhuman, doing really well. Enterprise Gmail.
Are we allowed to even mention it? Because we told Rahul that
he's got to get the MRR at a 0. No, we can totally mention it.
All right. Rahul, you're listening, buddy. Another zero, please. But I literally said, Rahul, we'd funded his prior company, Reportive. And he
Me
was,
too.
Yep, exactly. Both of us did.
Yeah.
And I love the fact that he was building an application platform inside of Gmail, the first one to do it. And now we have all that crazy stuff in there.
Cruft.
Yeah, it's confusing.
Yeah, Gmail's crufty.
So I said, Rahul, all right, you're going to kind of go back in your mission again, and it's important. He had this lifelong mission to make you brilliant at what you do.
Yep.
And you're in it with us. And I said, Rahul, I'll invest if I can be the first dollar in your bank account.
Huh.
He goes, that's kind of odd. Most people want to be the last in the round.
Yeah.
I'm like, nope, I want to be the first dollar in. And I tell a lot of the founders that, can I be the first dollar? Not even the first institutional, I want to be the first dollar in a lot of times.
Yeah.
That's fun.
And this gives you an advantage in terms of a marketing position, because many VCs now have said, we want to invest after you figure out product market fit and you have some traction.
Yep.
Why not? Why are they taking that position, and why do you take the other one, other than you get a rush out of it?
Yeah, I do get a rush out. It's fun.
Clearly.
I take it because, there's just a huge gap in the market right now. I mean, a lot of these larger firms, let's say that the best tier one firms in the Valley, they're almost like asset managers. I mean, they're brilliant at what they do. They have $1 billion or $2 billion under management. For them to write $1 million check into a company like Superhuman at the time that we funded, it'd be rounding error for them. They'd rather write a $20 million check at a higher price.
Like an Andreessen Horowitz with $1 billion fund. How do they write $1 million check? It's hard.
Exactly. It's the same amount of work. And in fact, it's almost more work because there's nothing really there. You really have to work with the founders very closely to kind of get them to that next point. You know, I call it going from founder market fit to product market fit. There's a lot of work that goes in. And writing $1 million check, they're not going to spend time with you.
So let's talk a little bit about that. How do you... And by the way, thanks for sharing your personal story. I think it's just amazing, and it's super relevant given the sort of geopolitical situation we're in right now, and inspiring. How do you decide who is worthy of writing a check and who isn't when you have zero data or product to go on in most cases? Are you only investing in serial founders so they've done a company before, or will you take a shot on somebody who is a first-time founder?
The answer is both. And a lot of it, as you know, Jason, it comes through our network, right? You know, when other founders, I think trust is transferred through the people that you trust as well. So if it's a second-time founder like Rahul or like Jevin that does Manifold and some other ones, it's much easier if you've worked with them before. But if they're very close to someone and say, hey, you know, you should meet my friend, they're the most brilliant technology or product person that I've ever met, that trust is transferred. And you have to spend time with the founder. But what we like to say is that founder market fit is all about, and since we're enterprise investors, we think about, A, can we add value to this founder? B is we only fund engineers. We want to make sure, and I think you've talked about it before, when you have co-founders, you want to have a technical person, at least, and a product person.
Yeah.
But we only fund engineers, and we think about, in their domain expertise, do they have the experience to do this? And if it's a smaller kind of new founder, they might require less capital. And if it's a repeat founder, they might require more.
Yeah, so the ability for them to actually build the product is critical. It's the idea of investing in somebody who's going to hire the team that's going to build the product. That's a red flag, isn't it?
Absolutely. And so the best way to do it, if, you know, as any software person knows, 80% of the architecture and how you diagram it and think about it, and then the coding of it is just kind of the grunt work, right? And so if there's nothing in front of you and they have an idea that sounds amazing, we sit down and say, okay, what's your architecture? You know, how are you going to lay this out? How are you going to build this? What are you going to do? And kind of spend a lot of time going through that process.
How do you value a company this early on? And do you even try, or do you just go with what the founder says they think the company's worth? What's your general rubric for determining value at such a nascent stage for a startup?
Yeah, look, I mean, the reality of it is that a lot of it's backwards. You want to make sure the founder's incented and owns enough over time. We as investors also need to own enough as well. So, you know, I mean, let's say in general, they're selling 20 to 30% of their company, 20 to 30% at that round. And, you know, at the end of the day, you add that math up a few times and you want to make sure that they, at the end of the day, after like a C or D round, they own enough to keep pushing forward.
So you think, we're going to have 20% dilution or so 3 times or 4 times. Yep. So you're at 80% and then you dilute 20% of 80%. That means you're losing another, I guess, 16% off of that, or 16 points off of that. Now you're down around 50s something. Then another 20%, they're at 40 something. Another 20%, they're at 30 something. And if there's 2 founders, they might wind up at the end of the day with 10 to 15% ownership, which I think is where Larry and Sergey wound up when Google went public.
Yeah, but they have a much bigger pie most of the time.
Yep.
I think sometimes, though, that's a great point. People lose sight that the goal is not to raise venture capital. The goal is to build a real business, right? To get a product out the door. Some people get lost and get caught up in the glamour wars of I raised more money than you, which is why the whole unicorn fad in my mind it was almost a bad thing, because it's not like you're creating an exit. It's just you're raising money at $1 billion valuation. And some people even artificially inflate their valuation with reverse ratchets just to say they're
Explain what a reverse ratchet is and how that would increase the value of my company.
So it'd be, for example, that I'll pay you a $3 billion valuation. And if you go public and you go public at a $2 billion valuation, I get stock back at the same price as the IPO. So you kind of get extra diluted if you didn't accomplish your goal, but you get to say I was worth $3 billion.
Right. And so one of the games that happened here in Silicon Valley is a certain group of founders became so proficient at raising money and increasing their valuation that if one were to look objectively at what they built, their greatest achievement would be their ability to pitch the business to venture capitalists and other investors and to increase the value of the company, not whatever the company's business was.
Yep, which is serving the customer and growing that. And the goal is eventually be a fast-growing, self-sustaining business. The sooner you can get there and get off the venture capital drug, the better off you are. And here I am saying that, and I'm funding companies, but you still need to get a start.
And if you were to do 2 or 3 rounds of funding and not raise again, that's amazing as well for the early stage investors because we're not getting diluted. So one of the great gifts you can give is if, let's say, Superhuman continues to take off, maybe Raul doesn't need to raise, another round of funding, or maybe the C and D and E rounds never occur. It just grows off of revenue. And Google was one of those super cash efficient companies. Yeah. They raised very little venture capital and they grew massively. So it can be done.
It can be done for sure.
It's just we have so much money in the system right now that it's almost a lost art in a way. And I think most founders feel if all that money's there and it's freely available, why not put it to use? How do you counter to your argument? Well, the money's there. It's free money. It's minimal dilution to put $20, $30, $40 million in the bank account. Why shouldn't I do it?
I'll give the counter argument for that. And let's say you have an opportunity to exit at a $300 million valuation, and you've raised $10 million, and your last post money was at 50 post. And you go to your investors who have rights to actually approve a deal or not that you want to sell. If your last round was 50 and it's a 6x or 5x up from that, then you're likely to approve it. But what if you raise another 40 million on top of that, and the last valuation was 200 posts? And now they're only making 50% return after 12 months. I can probably bet you that the VC who invested in the last round is thinking about getting 4 to 5x, and they're going to say no. And then let's take another step. What if the market drops after that 6 months later? Or what if you're not selling? You could be hosed. So it can work backwards.
Right. If you're setting the goalpost so far away that now instead of 100 yards to get a touchdown or 50 more yards, you're saying, let's set the goalpost at 1,000 yards away. And so all of a sudden you go from being on the 50-yard line to the 5% yard line, essentially the 5-yard line out of 1,000.
And that's a fine art because you tell founders like, hey, look, you want to get a good price, but more importantly, you want to get a good partner. But if you over-optimize for price, you could end up in a tough spot.
All right, when we get back from this quick break, we're going to talk about your portfolio and some of the great companies that you've invested in when we get back on Angel, the podcast. Let me take a moment to thank NetSuite by Oracle. Thank you, NetSuite from Oracle, for supporting Season 2 of Angel, the podcast. And the results are in. Survey Inc.'s 5,000 companies show that the top barriers to growth are that it takes finance too long to close the books, and that companies are too slow to launch new products, hiring and keeping good people, managing cash, and too many disconnected systems. It's very hard when your business grows to get a full picture of that business. And if this sounds familiar to you, it's probably because you've outgrown your business and financial management system. QuickBooks and spreadsheets are fine in the early days of a business. We've all been there. But it's probably now taking you 2 or 3 or 10 times as long to get simple things done and to get accurate answers about your business. And that's why you should know about NetSuite from Oracle. NetSuite is the one system that tracks and manages revenue, cash flow, HR, inventory, projects, even e-commerce for every industry. And that's what's important here. NetSuite is working across all industries, and it is a phenomenal product. Now you can run your business from a dashboard on your phone, and you do not have to wait to get these important answers that founders and boards and investors need to know. And that's why thousands of companies use NetSuite. It's the only system you need to run your business. So here's your call to action. I want you to go to netsuite.com/angel, netsuite.com/angel, and you will get your free guide called Crushing the 5 Barriers to Growth. That's right. Go to netsuite.com/angel and get Crushing the 5 Barriers to Growth. That's netsuite.com/angel, netsuite.com/angel. Thanks again to NetSuite. And you can go ahead and thank NetSuite as well on your Twitter handle or Facebook for supporting independent media like Angel. We couldn't do it without you. Hey, everybody. Welcome back to Angel, the podcast. This is our second season, and thank you to our friends at Oracle NetSuite for making the second season of Angel possible. We couldn't do it without their support. My guest today is Ed Sim. He's the founder and general partner of BoldStart Ventures, boldstart.vc. He's Ed Sim on the Twitter, and he is a great early-stage investor focused on enterprise. And let's take a look through some of these. I know you've invested in over 50 companies. You had 11 great exits. You're in GoToMeeting, one of my favorite products. Tell me about that. I mean, we're going back way back.
Way back. I find
that got sold to who?
Citrix. For a fair chunk of change.
Nicely done.
Yeah.
Is that your biggest win, cash on cash, or?
No, the biggest win I had cash on cash is a company called Green Plum.
Green Plum.
They're trying to transform the database and data warehousing industry by taking a Google-like approach, clustering commodity machines to get petabyte data warehouses. And we sold that to EMC.
Oh, wow.
And then for I can't say the price, but it was
significant.
And then what they did
How did you meet the founders of Green Plum?
I met them through a mutual friend who was a product guy, and he introduced us, and we started chatting. And the founder, Scott Yara, phenomenal founder, he was at Digital Island before that.
Sure.
Do you remember that? One of the Akamai type competitors. And he was kind of head of marketing strategy. And he had 2 or 3 engineering co-founders with him. And he said, look, there's a huge problem with Teradata and all these other large data warehousing companies. It costs $1 million, $2 million each. Why not build something where we can daisy chain cheap commodity cluster computers and scale that at 10,000, 20, and then eventually get to $1 million?
Perfect.
That was the premise.
Amazing. And how long was the time between when you invested and when you exited?
Well, I'll tell you a story. From 2000, we funded it, maybe 99. We exited in 2010.
So it was an 11-year journey, 11-year journey.
Yes, and it almost went out of business twice.
Wow.
And we ended up recapping the company.
Explain what a recap is to people who are neophytes and don't know.
Yeah, so look, being an early stage investor is super risky. And sometimes the product or the market doesn't go according to plan, and they have to pivot or try something different, and they need new capital. And so what a recap basically is like, okay, it's if you don't invest in this next round, your prior investment gets wiped out, and you're starting from ground zero. And you have to set a price that's attractive enough after the company's been through so much pain to attract new investors in. So that's basically what a recap is. So we got recapped twice. So
I invest $1 million in the company, and then the company fails to get anywhere that it needed to go to get more funding, and 5 other people put $1 million in. So our $5 million is in the company. Now you say, listen, the company's going to raise another $5 million, but your $5 million, it doesn't exist anymore. It's gone.
Yep.
And we're going to raise $5 million on a $15 million on a $10 million post. So you can re-up, put $1 million in for 10%, or you could not and get nothing.
Yep.
But those new investors are going to get the bulk of the company. This is something that is incredibly hard to communicate to your existing investors. Don't they get, as a founder, if you had to explain to your existing investors, I'm wiping you out, are they generally infuriated? And how do you handle that rage that you might experience because you'll never be able to raise from them again? Or do they understand it, that this is a last-ditch effort?
I think that it's last. They understand it. You have to communicate with your investors on a regular basis. You know, you and I have talked about kind of monthly reports or weekly reports. And when things even get worse, when things are the worst, you know, I like to say that good news travels fast and bad news doesn't travel at all. I think it should be the opposite. Bad news should travel really fast.
Yeah.
And then good news can travel at a regular
Bad
pace.
news at the bottom of the update, or if you hit reply to the update. Good news at the top.
Exactly. So if you communicate with your investors and go through a process and you try to raise outside capital and everyone says no, there's a whole process you need to go through. You have to get your lawyers involved too.
Yeah.
So that when you come down to it, it actually works.
Right. And I've seen this occur where people say, listen, we've emailed y'all 3 times in the last 6 months.
Yep.
The company's not working. We've done the layoffs. We tried to find a buyer. Nothing worked. However, we have a new investor who's willing to put $2 million in for a third of the company. Yeah. You get first shot at that, but everybody else is going to be crammed down. And sometimes they'll say, we'll take that existing group and we're going to give them 5% of the common or something.
Yeah, and that's what they usually do. You have to give them something.
Yeah.
And the amazing part is that this story worked out. And so what happened is
So did those people who got washed out actually wind up making a profit or just breaking even?
The people that got washed out.
Oh.
But the people that stepped in,
did fabulous.
We stayed with the founder. We had conviction in the founder and what he was doing. And here's the most amazing story. So partly why I'm here this week, besides the whole number of reasons, is that they spun that company back out when Dell bought EMC, and they created a new company called Pivotal. So Pivotal is a combination of Greenplum, Pivotal, and some VMware assets.
Yeah.
And they run this program called Cloud Foundry. And they had their annual developer conference in San Francisco. They had 3,000 people there.
Wow.
And then I was in a kind of a private event with them. They had 50 of their top CIOs who are the Fortune 500 sitting in a room. And I told the founder, Scott, I go, Scott, look here, it took you 17 years to get 50 of the top CIOs. I said, could you have ever imagined this in your wildest dreams? Yeah. He's like, no, man. And he's still going.
17 years later.
So this is one of the hottest infrastructure companies out there right now. They'll probably go public or something.
But you have no equity in it now. You've sold it. You're done.
Yeah.
But you still remain friendly with the founder just in case he starts another company.
Oh, yeah. He's already sent me a bunch of companies. And
amazing.
We're partnering with them too.
Yeah. And maybe he, now that he's rich, he'll be an LP in your next fund. Who knows? You never know.
Absolutely.
Okay. Going through some of the other ones, I know that you were, we know you're in Superhuman and Reportive. What is Catalytic?
Catalytic, yeah.
Catalytic. And Indiegogo you're in.
Yeah, that was
amazing.
way back in the
Going
day.
back in time.
Yeah, so Catalytic is a very interesting company. It's the founder was a co-founder and CTO of a company called Fieldglass, which sold to SAP for about over $1 billion. And he got tired of kind of boring enterprise software, and he said, I think the biggest challenge moving forward is going to be automating kind of boring business processes. So he wants to bring a modern approach to that. He's sitting on top of, Dropbox, Box, Slack, email, and everything, and running a layer on top, and then running machine learning on top of that as well to understand, for example, how does a bill payment cycle work? Maybe there's 10 steps, for approvals, and he's kind of speeding up that process. Fast forward, he built out this end user platform, and he's sitting in 20 Fortune 100s now automating business processes. Boring stuff, but it's really exciting to me.
How many companies do you try to invest in a year? And then how do you manage your time with boards and stuff like that? When does a board seat kick in for you?
Yep.
And how many investments do you try to do a year?
Yeah, so it's good. I don't think we have a rule of how many investments we do a year. Sometimes we don't do any for a few months. Sometimes we'll do like 2 at once. But let's say on average, it's 8 to 10 a year.
So one every other month, one every month, something in that range.
Yeah, and for us, there's all different kinds of portfolios. There's 500 kind of institutional seed VCs out there or something like that. And our approach is a different approach. We are kind of a high conviction approach. We want to work very closely with the founders. And we typically will have a portfolio of about 18 to 20 companies.
Per fund.
Per fund, yeah.
And then how many of those do you actually join the board of? If you're high conviction, is it every single one you get a board seat?
Some of them don't need board seats right off the bat, but we have Slack channels open to communicate with them. We spend a lot of time with video conferencing. So if they're just...
That's fascinating. So you open a Slack channel where on your server or theirs where you can talk to them.
Yep. We use a little hack. We'll use a little hack that we use, but we have a channel for every founder. And then we actually have a founder family channel for all the founders. Like 60, 70 founders are in there communicating with each other.
Amazing.
Yeah.
So they can share all those best practices.
Absolutely. Or upvotes on Hacker News, or, how do you do billing? What do you think is Zora for billing and things like that? So it's a lot of shared knowledge. Being an entrepreneur is lonely.
It is.
It's a tough journey.
I've been there. Super lonely.
Yeah.
It is. And how do you manage that? How much of your job is being a psychologist with these founders and dealing with their emotional state?
I would say that's a fair amount. I mean, even some of the companies, like we didn't know how to scale. I don't think anyone really knew how to scale kind of a seed fund, right? You know, sometimes you make too many investments, sometimes you make too little. But the one thing we did in our first 2 funds, we're in fund 3 now, is that we didn't take any board seats, but we decided to pick one thing to work very closely on with the founders. And fast forward, like one of our company's security scorecard, the founder sat in our office for the first month. Sequoia led the A round, Google led the B round, and I'm still kind of, I'm not on the board.
Yeah.
But I'm still very close to the founder, so calls me for advice a lot.
Yeah.
You know, kind of going through hard times because we got in so early that there's this inherent trust kind of built in with us.
You don't need to have a board seat to have influence over the investment.
Yeah, I think the real question is are you a first call investor, right? First check investor, and are you the first call? You don't have to be a board seat to wield that relationship and influence too.
Yeah, no, I never had a board seat at Uber or Thumbtack or some Wealthfront, any of those early investments, and those founders always would call me.
All amazing investments, by the way. So
they did okay, yeah.
That's pretty solid, man.
We're at a top right now in terms of the stock market. Stock market is the largest bull run as we sit here, largest bull market since World War II, second to one. So we're at a 10-year bull market or so.
Yeah.
We're about 6 or 9 months away from being the longest bull market since the end of the World War II. How do you think about markets and timing? Do you think we're at the halfway mark to a 20-year bull market, or we're 2/3 of the way to a 15, or we're 2 years over where it should have blown up already? And how do you think about that? Because I have to admit, like I usually don't get frazzled by things, but I look at the stock market, I look at the geopolitical situation, I look at the Mueller investigation, and I kind of get a little nervous. And I'm not one to get nervous, but I'm looking at it going, seems a little dicey out there. Are you worried?
Yeah, I'm always worried, whether it's a good times or bad times, right? I mean, that's kind of part of our
paranoid survive.
Yeah, exactly. Andy Grove, great book, by the way.
Yeah.
But like, you know, you and I have been through some cycles, right? We've been probably through 2 or 3 cycles where
significant ones.
The stuff hit the fan. Let's put it that way.
End of the world cycles. In fact, if you think about 2007, the financial crisis, 2008,
and there's 2001 as well.
2001 with 9/11 and 2000 with the dot-coms. You put the dot-com plus 2000, 9/11. Those two were just like a 1-2 punch, destroying the market. And then you have the 2008, but before that, 1995, there was a little correction, and 1988.
Yes, as well. And the thing is, if you've been through these cycles, you can never get too happy. You can never get too high or too low. And I think what's very important for a founder is that you need the right signals to scale your business. Like, don't overspend, right? I mean, that's the most important thing. And the other part is when you fund engineers from a early stage perspective, if the world does go to hell and they really believe and are passionate about their product, if they're mission driven, they will cut back on their salaries and eat ramen or whatever they will have to do and keep coding away. And eventually it will change, right?
Yeah.
So you always have to, in your own mind, be prepped for that. Always have that scenario in your back of your mind.
In a way, it never. You don't want to be cheap when running a company, but you want to be frugal.
Yeah, you know what's funny? I funded some founders who these guys were one of the darlings in the industry for a while. I can't say their name; it's still stealth, but they grew really, really fast because their investor said, "Keep running, and then it ended up not doing so well.
Right.
And now, like, we funded the company. The founders learned so much from that experience. And now they have three customers. And the founder one day goes to me, he's like, "Hey man, like I'm almost cash flow break even." I was like, "Hey, pause for a second." I was like, "That's nice, but you have signal right now from 3 massive Fortune 500 customers that want your product. I think you should start hiring some more engineers."
Right.
And so he's
actually gun shy.
Yes, he went. Yeah, I call it. He just went psychologically from run really fast to the right, and then the pendulum went back to the left. And said, "Let's find a middle balance. You don't have to be in the middle. Maybe 33% on that pendulum swing."
Yeah.
He moved too far back the other way, and finally he's like, "So this is the whole psychological aspect." I'm like, "Hey, just move it a third. Move the needle a third."
Yeah.
And he calls
Don't
me
get
up.
ahead of your skis, as we say, but you certainly don't want to be sitting at the top of the mountain while everybody's enjoying the slopes.
Yeah, and the other thing that happens a lot too is just because you have 1 or 2 customers doesn't mean you have product market fit. I mean, I think
explain that. Why?
Because I think that product market fit is to get your first cold customer in that doesn't know you or doesn't know anyone else. When you get that person buying your stuff,
An authentic customer.
absolutely.
Not my brother works at this firm, or I worked at that firm, or
Yep.
I have a relationship with somebody there that got me in. Those are kind of faux.
Absolutely. And then eventually, as you keep growing, you want to figure out what is my repeatable on the enterprise side. What's my repeatable sales process, right? And kind of do I have a cadence of How much does it cost to get a lead in? How much does it cost for me to process a sale? How long does it take?
Yeah.
And what's my value proposition? And a lot of times people get false excitement. They might close for some very random reason, but they really start scaling up and hiring 10 salespeople. That can be the kiss of death, by the way, if you hire too many salespeople too quickly as well.
Yeah. Too many salespeople too quickly, and then you don't have product market fit, and they're expensive.
Yep.
And then everybody's going to be angry because there are no commissions.
And you're looking at a terrible scenario.
Yeah, it could be a real culture killer too.
Oh, absolutely.
And that in enterprise, it seems to be the big challenge of enterprise after product market fit seems to be scaling sales.
Yeah, I think that's a huge one. It's about execution and then starting to, you've got to, we fund engineers. So over time, eventually you've got to go from a product-driven and tech-driven culture to a sales-driven culture eventually.
Right. And that takes the heroes in the company from being the engineers to being the top salespeople.
Yeah, but if it's the CEO is kind of strikes the right balance, that's his job to manage that healthy tension between sales and engineering.
Right. Who's the hero this week? You almost got to give like the employee of the month for sales and the employee of the month for engineering, so that people understand that there's this balance.
Absolutely.
It's interesting, with the people getting ahead of their skis. I remember so many businesses back when Silicon Valley blew up in the dot-com era. So many of the businesses that failed, it was because they didn't raise enough or they had too big leases. And they had these huge leases, whether it was Razorfish or DoubleClick or iVillage. And then some of the magazines also had booked non-refundable deposits and or commitments to the Ritz-Carlton, Laguna Niguel, the Four Seasons, whatever. And so Industry Standard and Upside had all done $1 million, $2 million, $3 million, $4 million events.
Yeah.
And in order to lock down those conference spaces, they had to give them $1 million or $500,000. And they had to host those conferences no matter what. So they were left in a position where they had a $500,000 commitment minimum or $1 million commitment, and no sponsors, no people buying tickets, and they had to decide, do we go out of business or do we just pay them $1 million fee? And to the credit of those hotels and those resorts, they said, we'll take all the money. We're not negotiating. They sued them. And this is what took down Industry Standard, Upside, Red Herring. They all had just crazy commitments to leases because they all came to me at Silicon Valley Reporter. I had none. Because I would never sign anything. I'd be like, I'll pay you 30 days out from the event. I'm not signing a contract now. I was scared to death of signing contracts.
I think that's a great point because in that carnage, there's also rebirth. And so you're sitting in an interesting position, right? And so even GoToMeeting, the interesting story is that the VP marketing at the time is a guy named Bernardo. And Bernardo eventually became GM of Citrix, grew at about $600 million in revenue. But the brilliant thing he did was when all the ad people were leaving Yahoo, he went to Yahoo and said, I'm only going to pay you for converting a GoToMeeting kind of video conferencing client if they actually pay. I pay for performance, right? That's what he did. He was one of the first guys that did that. His ads were everywhere, and he wasn't paying for them. Everyone saw that brand coming out.
Amazing.
He grew out of the carnage. That's how they grew.
Yeah, there's an opportunity in the down market. I think this is something we're seeing right now, and maybe you could speak to this. Last week, Fred Wilson wrote a piece about the shutdown that I guess some deal book data came out.
Yep.
To summarize it, and I wrote a piece on it too about the seed slowdown. It turns out we're off the peak of the dollar amount slightly, like maybe 20, 30%.
Yeah, about that.
But we're down 50% in terms of the number of seed deals. What since the peak? And a lot of people who, after I wrote my piece, said, oh, this is ICOs are doing it. But I said, wait, the first ICO was in 2017. Most of them have been in the third or fourth quarter of 2017. There were no ICOs before that. So this slowdown occurred way before ICOs. So ICOs are not the explanation. What is the explanation in your mind?
Well,
Why did seed slow down so dramatically in terms of the number of deals?
Well, I think two things. One is you and Fred kind of highlighted just the whole angel investing kind of crew. Your book. Having to digest all the investments they made. So that's a point. And I think also that there's two more phenomena. One is that, for example, of the 18 companies we have in Fund 3, 6 haven't even announced, and they've been around for 15 months. So I think there's a lot of unannounced companies that are out there. So
why would a company not announce? Explain that to people. Why do people stay stealthy?
So let's say you're 3 engineers, you think you're cracking in kind of a new market opportunity. Why do you want to draw attention to yourself? I mean, having a $2 million round or $3 million round, particularly in enterprise, by the way, is not that sexy or exciting. really. So why announce the funding? That's not even that's great. But I'd rather announce, and these founders would rather announce when they have their first 2 or 3 customers. And then they announce their funding along with it. So,
Got it.
And we're getting in so early, pre-product, they're just building.
Got it. So you think that one of the reasons, this is something I hadn't even considered when I wrote my piece about it, maybe 10% of the rounds are just not announced.
Absolutely.
And back then, people were announcing because it was a, bang the drum.
Yeah.
Hey, look at my valuation, look at my thing. But now people are trying to be a little understated and saying, maybe I don't want to tip people off.
Yeah, I'd rather not. I mean, we tell our founders, just wait till you get customers. Like, yeah, it's great. I mean, the only negative is like hiring people might be harder since you don't have. But if the founders are amazing and they have an interesting kind of angle for what they're doing, I think it's a better move to kind of make. For sure.
How has New York changed in the last 25 years since you've been working there in terms of a startup hub? I know when I started, we had Voyager, we had Razorfish, and, Prodigy. There wasn't much going on. Sudo, Jupiter Communications. You could count the number of technology companies on 2 hands. How has it changed in terms of the ecosystem? Is it ahead of where you thought it would be? Is it about right? What are the pros and cons of being an entrepreneur there as well?
I'll give you kind of, how about this? If I give you 4 descriptions of companies, and you tell me where do you think they would have started?
Okay, good.
All right. How about decentralized biometric security for Fortune 500 companies? Blockchain-like approach.
Israel.
Okay.
I would have put it in Israel.
All right. New York.
Okay.
Okay. How about Splunk for your customer data?
Yeah, Palo Alto.
Okay. New York.
Got it. Okay.
How about...
if I don't get these last 2 right, I'm an idiot. But I'll play the game.
All right, yeah.
I'll play the game properly.
All right, we got it.
Sounds like a Israeli company, Palo Alto company, okay? Biometrics and big data, got it.
Yep. How about a continuous dynamic code testing for developers?
Yeah, so that would obviously be San Francisco.
Yeah.
Got to be in San Francisco.
New York. And the last one will be, how about a real-time streaming infrastructure platform that's open source?
Open source.
Real-time streaming infrastructure.
Real-time streaming. So I would say Seattle, San Francisco, probably, because Seattle's got a big, group of people in that space.
So New York.
What?
Yeah. So
all 4 answers were New York.
Yeah.
God, I didn't catch the trend.
Oh my God.
I couldn't catch the trend. But no, it is. These are very high-tech companies now. You do have a deep technical bench who does not want to go to work for Wall Street.
Absolutely. And that's the thing is that I was asking someone today, when you think of New York, what do you think? Ad tech, media. Guess what?
And Wall Street.
And Wall Street.
Yeah, Madison Avenue, Wall Street, and then news.
And so now what I'm trying to say is that you can be anywhere with open source. You and I talked about it last time, right? Kind of there's a lot of information. I mean, you're doing a great job putting all the information out for people to understand how to build a company.
How to be an investor.
How to sell a market, how to be an investor. And I think you can build great companies anywhere, right? People can code anywhere. And so the point is that New York is changing. It's changing. There's enterprise technology. There's a cryptocurrency community in New York. Big time.
Ethereum.
Consensus, is down there. And we also partnered with IBM to build an enterprise blockchain lab.
Wow.
And IBM's in New York as well.
You believe in the power of blockchain and cryptocurrency and ICOs, or take me through how you think about it? Because I'm looking at this going, I've never seen FOMA and a lack of actual something being there based upon the growth since the dot-com era and like the globe.com. This to me seems like it's about to collapse on itself. Am I wrong or am I right?
I'll give you two answers.
Good.
Yes
I'll
and yes.
Okay. All right, so it's insanity.
Yeah.
And it's real.
Yes. Yeah. So for example,
unpack it a bit.
I'll separate the two out from ICOs versus pure enterprise blockchain, which is the underlying infrastructure that businesses use.
Okay.
So on the pure ICO side, I think about that. A lot of that's kind of consumer driven in the sense that you're issuing tokens out or incentives for someone to keep using a service.
Yeah.
Right. And so that's very consumer driven. For example, someone came to me and said, I'm doing decentralized compute cycles on your phone. I'll give you tokens the more you use that on your mobile phone.
Sure.
I'm like, do I really give a shit? Do I want that on my phone and making 10 cents a month out of that, keeping my phone plugged in at night? No. But that company's going to go raise $200 million.
Amazing.
Yeah. So that to me is like, I'm not smart to figure out which one of the 1,000. I do think there'll be 1 or 2 fundamental underlying companies that become massive.
Out of
10,000, right? I mean.
Okay, so you have to hit a 1 in 5,000 as opposed to our day job, which is meeting with 1,000, maybe 100 qualified companies to pick one to invest in.
Absolutely.
And it's 1 in 100 we invest in or something, or 1 in 20 we invest in returns the fund.
Yeah.
Not 1 in 5,000.
I mean, and there's so much money pouring out. So that's the ICO side. I'll call that more consumery because there's got to be incentive. Yeah. If you talk to, I mean, we have a CIO advisory board of people from the largest banks and insurance companies, and they've been telling us about blockchain for a long time. So we partnered with IBM. They have a open source product called Hyperledger Fabric that Oracle and SAP are behind as well. And they're literally working with 100 plus enterprise customers doing blockchain software, right? Track and trace. They're doing kind of add viewability on that on the blockchain, right? There's auditability around it. So I think that there's tremendous opportunity in the underlying infrastructure of that. And that's what we're exploring right now versus the ICO side.
Yeah. I have to agree with you. There's some real technological innovation here, especially around a distributed function for things that were typically centralized. Obviously, the internet is a distributed system that has withstood massive attacks, denial of service and otherwise. Or
even Skype, right? I mean, Skype was decentralized.
Peer-to-peer, all this peer-to-peer technology. And if you even look at cloud computing and DNS routing, we have all these great systems for making sure there's no single point of failure. But we don't have that on the content space. We don't have that in storage in some cases. So these, whether it's Filecoin or some sort of distributed content system that would be impervious to people taking the content down, which has the pros and cons. There could be some really mind-blowing ideas here.
So that's kind of our experiments. And the thing about it is that I know you're a history buff, right? You like history. And so I always think about history. And technology goes in waves. We started out with the mainframe world, right? And then we went to client server, which basically was a distributed architecture. Now we've gone back to the mainframe world, right, with the cloud. And the next evolution, and we put it on our website, is decentralized computing. And that includes two things. One is the blockchain, right? That's a distributed kind of computing infrastructure. Because the processing power on the edge is becoming so fast. You can do so much more. The other reason why I think is because the amount of data flowing around, I kind of always like to say that there's 3 certainties in life. It's death, taxes, and the growth of data. It's just exponential. So the ability to process everything around us means you need edge computing cycles, whether it's on your phone or in your car or on a street pole lamp or even in a data center. So we're going back, I think, to a hybrid world where the edge is interacting with the cloud. Yeah.
It's definitely the case that we're not having dumb terminals in our hands anymore on our desktops. The power is getting so ridiculous due to mobile phones and GPUs that nobody expected that, the amount of computing power that can be put into a car today allows for self-driving. Where nobody thought that you would be able to have enough computing power mobily to do that reasonably.
Unbelievable, right?
Yeah.
It's exciting times. I mean, I just came back from reInvent last week in Vegas.
The Amazon event.
Yeah, the cloud computing event. 46,000 people there.
For the cloud.
Registered. Yeah, just for the cloud. It was unbelievable. I mean, Bezos is taking over the world. That guy is unreal.
It's pretty interesting. I mean, if you had to own only one stock, your entire net worth in one stock, which one would you pick?
I'd probably pick Amazon right now.
Yeah, a lot of people feel the same way.
Because they cover everything. I mean, they cover consumer. I mean, look, the cloud thing's doing 20 billion run rate right now and throwing off 4 or 5 billion of profit.
It's crazy.
Yeah.
It's crazy. And they don't buy ads anymore from us. That's making me crazy.
Oh, that sucks.
They're so cheap.
You know what? They are cheap. So when
I'm joking.
But
it is true. Like Bezos has these weird kind of concepts where they were marketing a lot and then all of a sudden we didn't hear from them and then we were hearing from everybody else, but they're so profitable.
I was going to say they're really cheap though. That's culture. I mean, he started out. So I'll give you an example. If a founder comes to me.
They paint their desks.
Yeah. If a founder comes to me and says, one of my exits is to Amazon, for AWS, I say, nope, because they won't pay more than 10 or 20 million. That's it. No one can make enough money doing that.
No, they really have, with the exception of Whole Foods and Twitch. Twitch was $1 billion. Whole Foods was $13 billion. I think they're going to get more acquisitive.
They have to, because I think from my perspective, if you talk to the other VCs out in the Valley and here, we're like, hey, if you don't start buying companies at a premium, Microsoft and Google are, and we're just going to gang up against you, dude. Yeah. Like literally. And I know you're the juggernaut, you're running away, but multi-cloud. We'll go in multi-cloud, man. We're gonna bring everyone else together and go after you.
Well, yeah, I think multi-cloud is what most people will wind up doing anyway, which I remember when I was on the board of Dyn and talking to some of the customers they had and talking to some of the sales reps over there, a lot of people were thinking if Dyn is pointing my DNS somewhere, can we send half the traffic to an instance at AWS and half to IBM's cloud and a third to Rackspace or whatever it was, just cloud balancing.
Yep.
Which nobody has taken the time to do, but you could cloud balance.
You are spot on. So I spent the last
that product doesn't exist, right? A cloud balancer?
People are working on it now. So it's kind of funny. I asked, what is the definition?
You're smiling. Does that mean you have an investment in the space?
I'm looking.
Okay, will you please include me? Because I think that this is a killer idea.
But here's the thing is like, if you interview kind of the largest companies who are putting all their infrastructure in the cloud, and you say, what does multi-cloud mean to you? There's two ways to look at it. One would be cloud balancing. So taking an application and distributing the workload of that same application across multiple clouds.
Right.
That's harder to do. That's what you're talking about.
Super hard to do.
That's what you're talking about. The other way to do it is just to kind of avoid vendor lock-in, right? When they grab you by the you-know-what, and then charge you eventually 10x what they're charging, is to pick the best of breed of each cloud. For example, I'll pick TensorFlow from Google to do my machine learning. I'll pick AWS and S3 because their storage is really cheap, so I'll put my whole data lake on that.
Right.
And then I'll go to Microsoft.
SendGrid for my email transactions.
Exactly.
Dyn for my DNS.
And by the way, I'll push a company right now that does that.
Yeah.
It's called Manifold.co. And they are actually a platform to create all the coolest developer services with one username, one bill. And they bring the best of breed. You're not reliant on Amazon to bring, the coolest developer services. So you go to them, and they're multi-cloud.
Yeah, it would be really neat if you could just pop up the instance of your application.
Yep.
And say, if you authenticate with Amazon or IBM or Google or Azure, you can instantly log into your Superhuman. Let's say Superhuman as an example. Just had a Superhuman instance on all 4 cloud computing platforms, and you would never be dependent on one. So if AWS goes down again, you would be the other 3 would be up. Because you can cold storage them too, right? You could have the instances there sitting to move at any time, but it takes sysadmin and developer time.
But the coolest trend right now is serverless. Serverless technologies, where and Amazon announced the serverless database.
Yeah.
So instead of having kind of databases up and running, it only pops up to actually record the transaction and stores it in S3 and disappears. So think about it, you're turning computing into a per transaction event.
Amazing.
Absolutely insane. It's mind blowing. But anyway, I know we're geeking out, but
we are geeking out, but that's where the good stuff is somewhere in that geek stuff.
Yeah, it's exciting.
And the best way to get to you, if you're a founder, is cold email or an introduction from one of your founders.
I challenge the introduction from a founder or someone that I trust, because if you can't get to them, then you're probably not going to be able to sell into a Fortune 500 company.
Got it.
Right?
Yeah, that is the ultimate test. If you're like, how do I meet a VC? It's like, well, you've just disqualified yourself from being an entrepreneur. Because if you can't figure out how to find these people, it's like on their website, on Twitter, on LinkedIn, on Facebook, on everything. They're everywhere. They're so available, it's annoying.
It's unbelievable. I mean, think about it was mysterious. And it's funny. I was talking,
it was mysterious in the 90s.
Right, yeah.
I didn't know nobody knew who a VC was. You didn't know any VCs.
Yeah. How do you know that, right? And our job has changed too.
Yeah.
I mean, and the transparency. I mean, we have to be transparent. You have to tell people what you're doing.
Yeah.
Because there's so much money out there, and everyone's money is green, and you really have to provide value.
Back in the day, getting a term sheet to look at was like, nobody knows what a term sheet looks like. And it's like, oh, well, maybe your lawyer will show you one. But now you have Brad Feld or Fred Wilson or whoever, Mark Suster, like, let me write a 5,000 word article on the nuances of a term sheet. And Wilson Sonsini is hosting, a term sheet seminar every 30 days in their office. Like, the information is now freely available.
It's unbelievable, right? And then you have NVCA standards, all that stuff. So it's good.
All right, listen, we could talk all day, and we have. We went to dinner last night, and we're talking today. Ed Sim is the founder and general partner of BoldStart Ventures. You can go see boldstart.vc or FirstCheck VC.
Yep, FirstCheck.vc.
FirstCheck.vc.
There you go.
You're really using that VC domain name.
I know.
It's pretty cool. Was that Vancouver, or what is VC? Does it actually?
I don't even remember.
Is it a geography or no?
I don't remember.
Know.
Yeah, it's got to be a geography somewhere.
Who knows? And he's Ed Sim, EDSIM, on the Twitter. And thanks again, Emmy Award-winning producer Jackie. And we'll see you all next time on Angel, the podcast. Bye-bye.